Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And this episode is sponsored by ARC Silver Gold Osmium. They offer personal service and often the lowest price, period, with no minimum purchase for silver, gold, platinum, or osmium. ARC SGO is available to discuss precious metals by email, phone, or in person at their retail location in Jackson, Wyoming, and they are committed to providing the best prices out there and making sure you get the best value and lowest premiums on their wide selection of products. Go to arcsgo.com and contact the owner, Ian Everard, at 307-264-9441 or Ian at arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an economist, a leading authority in the areas of precious metals, money, and credit, and the founder and CEO of Monetary Metals. It's Keith Weiner. Great to have you back on the show.
Hey, Jesse, thanks for having me back.
Yes, happy to. I always enjoy our discussions. And I want to start with your broad overview of the economy and financial markets before we dive specifically into talking gold and silver. What are the main trends and developments you're currently watching when it comes to markets and the economy that you think investors should be paying attention to?
If I had to boil it down to one thing, is there's a spread between junk bonds and treasury bonds, which is an indicator of stress. And everything else that people like to talk about all day long when they have economists on their show or on CNBC or Bloomberg or whatever is GDP and inflation and employment or unemployment. But all those things are downstream of credit. And to understand what's really going on, you got to look at credit. And to understand credit, you got to look at an indication of stress. And it's a bunch of different ways of looking at it, but one of which is the spread between junk and treasuries. And there's a variety of means for that. I happen to use something called the Bank of America Merrill Lynch B of AML option adjusted spread. It's a little bit technical, but that's one way to do it. You can look at JNK minus TLT or the other way around. Which are ETFs. The story there is so far, at least, that's the dog that did not bark in the night, for the Sherlock Holmes story. There's something that isn't happening right now. And that's the $64 trillion question is before interest rate hikes, we did something on our podcast called for Halloween for October, Zombie Month. And the Bank for International Settlements defines a zombie as blah, 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 company whose profits are less than its interest expense. And since in order to pay interest, you have to have profits, it's kind of worrying if a company has profits less than its interest expense. That means it isn't viable. And there's no way out. Most zombies either remain zombies or fail. So zombies are possible because of really permissive, really forgiving, credit markets, both ultra low interest rates, obviously, and creditors that are, I'm happy to lend you money, even though I can see you can't even service your debt, let alone repay the principal. I'm happy to lend you money anyway. I'm okay with that because I'm a masochist who, I don't know. So at that time, this was before the interest rate hikes began. 20% of corporate debt outstanding was zombie debt, which should be a terrifying number to anybody when you hear that. 20% of all corporate debt extant was zombie debt. And, you hike interest rates, it's kind of like hiking the minimum wage. People think, oh, that means everyone gets more. No, it's the cutoff. It's the threshold. If your labor is worth $10 an hour and the minimum wage is $8 an hour, then, okay, you are employable. They hike the minimum wage to $15 and suddenly you are not employable. If you're getting a return on capital of, 3% and the cost of credit to your type of firm is 2.5%, okay, you're not a zombie. They hike the interest rate, they hike the Fed funds rate to 5.5%. Assume, your type of company is paying 8 or 9 or something like that. It doesn't mean your return on capital is going up. You're still at 3%, but now your cost of capital is 8 or 9. You are suddenly very not very much a zombie at that point. So we don't know. I haven't seen the data yet. How many firms now, or how much debt that's outstanding now is zombie debt? Has to be a lot bigger. And credit markets should be less forgiving in this type of environment. Investors are certainly under less pressure to, as I say, reach for yield or quest out along the yield curve. With the Fed funds rate over 5%, T-bills having 5.5% on offer, why in the heck would anybody lend to a company that's not viable and isn't bloody likely to be viable? And yet, there was a little bit of a blip a couple of years ago in this spread, and it's been trending down ever since. That is, junk bonds are trading tighter and tighter to treasuries, ever since the last couple of years. So, that's the thing. If you want to reduce it down to one thing I'm watching, that's the one thing.
Well, considering that people can get 5% plus on T-bills, as you mentioned, this is generally an environment where people don't look to gold. And yet, at the moment, it obviously has reached and sustained all-time highs. What do you think are the catalysts behind this move for gold? And how do you see gold's price action unfolding over the course of the rest of the year?
Two very good and very distinct questions. What's the driver of that? So, on Twitter, I guess maybe I follow a disproportionate number of, let's say, U.S. gold, maybe retail-oriented gold dealers in that whole space. And they're saying, there's no demand for gold. What's going on? You look at outflows from the ETFs and all these things. But I think there are four major regions of the world. So retail demand in the U.S. and in the West is really slow right now. I mean, any retail dealer, whether it's the U.S., Canada, Australia, New Zealand, the U.K., Western Europe, will tell you that volumes are down and margins are down as well. Which, margins, I guess, bad for dealers, good for retail buyers. If you want to buy a coin and not pay a huge premium to the metal price, now is a good time to do it versus a couple of years ago. But that doesn't mean that demand is moribund. It just means retail demand in the West, and I emphasize retail in West. So I just met with somebody who sells to, we'll say, sophisticated. So I'm in Singapore at the moment. So this is a Singapore-based business that sells to mostly Western, but not retail. They sell to family offices and institutions and others. And they see demand being booming right now. So these are folks that are larger, certainly in size, generally more sophisticated, and specifically they're buying to store here in Singapore or in Hong Kong or these types of places. But broadly, I would say you have China, India, Turkey, and we'll call it the Arab world. We're demand in all these places is really booming at the moment, and that can change. And there's in the gold space, there's almost a perpetual narrative that gold flows from west to east, and it's not true perpetually. I mean, there are times when this absolutely reverses, but right now it is. And so, if you look at each of those four worlds, they have different drivers, and they're doing it for different reasons. And it's very pat, it's very glib, it's very convenient to say, oh, it's an anti-dollar play. But if you look at India, just to take one, their currency, it's not hyperinflation. It's the same as it ever was, which is their currency is designed to go down, and it's pretty successful at doing what it's designed to do. It goes down. I think I saw the number 7% a year against the dollar, and the dollar is designed to go down to 2% a year. And obviously, the dollar's managers can slip up and let it go more than that. But if you have a currency that's falling 7% against the dollar every year, that's a pretty inflationary currency. And so Indians always turn to gold. They always have essentially unlimited, at least want for gold, but economists use the term demand as when want matches, ability and willingness to pay. And right now, that demand is turned on, and that depends on the monsoon season and their ability to grow crops and other economic conditions internal to India. And right now, those are conducive and people are buying. Now, you take Turkey, as a whole different set of drivers there. The Turkish currency is also a weak currency designed to go down, but it's going down a lot more than the Indian currency at the moment. And that is potentially, it's not hyperinflation yet, but it's potential hyperinflation. So everybody in Turkey, I'm told, you know, and anybody that has any degree of money at all would have at least 10 grams of gold in Turkey, and the average person would have more. And for, wages being a lot lower there, that's a fair, but, a third of an ounce of gold, a minimum. The average person probably has several ounces. Inconceivable in America that, everybody would be like that. I visited the Grand Bazaar in Istanbul, and had a guided tour. I probably saw 100 gold merchants, one Bitcoin kiosk. I have to say that, but it's not an anti-dollar play in either India or Turkey. It is a anti-local currency play. That they're terrified of their local currency, and they buy dollars too in both of these places. But they have capital controls. That buying dollars can be difficult and it's discouraged in a lot of ways. But they have access to gold, so they buy gold. Now in the Arab world, it's different. You look at the Gulf states; their currencies, many of them are pegged to the dollar. And unlike, let's say, a Latin American banana republic, those pegs in the Arab world are table flat, stable over decades. Nobody has any reason, not just UAE, but other countries in the Gulf region. Nobody has any reason to wake up tomorrow morning and worry about their currency. Currency's doing fine, but they turn to gold. I mean, obviously, in part, just as in Turkey and India, they have a cultural and religious affinity to gold. But, part of it, goes beyond that. Let's just say they don't, in a lot of cases, they may love Americans. They've certainly been very friendly to me in all the countries I visited there. But they don't love the dollar and the dollar policy. And so it is a bit of an anti-dollar play. But also, they're just more sophisticated in understanding of gold generally and what they expect to be able to do with it. So it's a great opportunity for monetary metals and the types of things that we do with it. And then finally, you get to China. So China has import limitations. They curb imports of gold, at least at times. And, so if there's buying internal to China and you're not allowed to import it, then the price of gold within China, rises. And, people make much ado of this fact. So, that's true price discovery. No, it isn't. It's the opposite of true price discovery. It's a government literally slamming down a wall and saying you're not allowed to import. And so, there's an arbitrage. There's a gap between, the world price and the Chinese price, and nobody is allowed to arbitrage it. So that gap can grow $100 or at times or whatever it is. And they're all buying as an anti-yuan, anti-Chinese government play, which is why the government doesn't like it and clamps down restrictions on it. They're all looking for ways of not only getting out of the yuan, which they don't trust, but getting out of the radar screen of the Chinese government. And if you have a financial account, the Chinese government obviously knows everything that's in it. If you have a piece of metal in your pocket, it's a little bit more anonymous, much harder. It's impossible to track, obviously. So you have four regions that are buying gold as much as they can, and for quite different reasons of why. And so obviously, those are very populous regions, although wages are lower and wealth levels are lower. But those are very populous regions, especially China and India. Turkey is no small country either, and the Arab world isn't really small. So there's buying going on there. The American retail public isn't buying, although I note not really selling in big volumes either, just not buying in big volumes. And so, here we are, $2,200 yesterday. I guess today's a bit, or at least my yesterday and today is a little bit skewed because I'm a day ahead in Singapore. But, within the last, 48 hours, we broke $2,200. We fell below that at the moment. And these are some of at least the mechanics of what's going on. One other thing I
That's
want
a
to say to that, I'm sorry.
yeah.
Monetary metals, we track what we call the gold basis. And, we've written probably hundreds of articles talking about the theory of it and how there sort of is a better understanding of supply and demand and all these things. But at a very mechanical level, it's the price of a futures contract minus the price of spot. And so, at mechanical levels, you have these two things. There's an arbitrage. So if this one goes up, if let's say someone's bidding up futures, then arbitragers will pull up, spots. So they'll buy spots, sell forward, and arbitrage that gap. But if there's just relentless, ferocious buying of futures, this will push up more aggressively, and this will follow more reluctantly. And so if you think if there's a spring attaching these, the spring is a bit stretched and the spread will widen. That's been, since going back to the peak of gold price in 2011, that's been the pattern. When you see the price of gold flipping up as now, you see that spread widening. And that means that it's, futures market, players using great leverage to bid a futures that they're trying to front run something. And I can't tell you how many times, the gold community said, moonshot, moon rocket going to the moon. And I'm like, no, 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 it's the futures people. They're trying to front run something, but they're going to end up only front running themselves. And, we wrote articles measuring the half-life of like the blip and how long it takes to come right back down to where it was. And, it was never really a healthy dynamic. If you wanted to bet on a general rising trend in the gold price, that wasn't a good sign. This time around is different. We're not seeing that. We're seeing that spread is either holding steady or even compressing slightly as the price has pulled up, which means it's buying of physical metals. So not only is American retail, people buying 1 ounce eagles and maple leafs and British sovereigns, not only and 1 ounce bars and 10 ounce bars. Not only is that buyer not really in the market right now, but neither are the Western futures market buyers. This is an Asian Eastern buying of physical metal is what's driving this, and the gold basis absolutely shows that.
So, do you expect this trend to continue moving forward, to accelerate? Do you think that we could see a pivotal moment where the Western buyer enters the market? We see more retail activity in the West once they kind of maybe wake up to what's happening with the monetary system. What are your thoughts there on this trend potentially accelerating or not moving forward?
Yeah, I absolutely do. I mean, that's acceleration. That's a whole different thing. But I see the trend continuing. Um, at the moment, we're in the most crazy, like stealth, I've heard this term stealth bull market, kind of like, 2002 to 2006. It was like, yeah, people weren't that excited about it. They weren't talking about it. At the moment, not a lot of participation in the West. Um, and, you look at the dynamic in China, you look at India could turn because it's very dependent on, their incomes for those folks. And a lot of that's agriculture. So if they have a bad season, then they're selling gold in order to buy food, and there's nothing they can do about it. Is what it is. I don't see that dynamic changing necessarily in the Arab world. I don't see it changing in Turkey. I suppose they could become poorer. The government's policies could grind down on them, and then deprive them of any means to buy gold. But with the currency doing what it is, gold is a great outlet for them. Um, and uh, and in China, again, I mean, if economic times just get harder and harder, I guess there's a point at which people don't have the ability to make any more savings, so that could turn around. But I'm not sure I see those things turning. And so what I would say is we're definitely in a bull market for gold, or as I look at it, a bear market for the dollar. Um, so the dollar is at 14 milligrams of gold going down, which isn't necessarily a good thing. It is what it is. Now, what can certainly happen if the bull market in gold / bear market in dollar continues long enough, even the slowest retard in the class will eventually wake up, come to, oh wait, oh, there's a trend, and when the trend is noticeable enough, then they begin to pile in, and so then you get that exponential, um, parabolic move, um, and then of course the risk of a drawdown becomes much greater, and because it gets ahead of itself and it comes back down. But that I think is ahead of us. And the other thing is when the Fed, and I say when, not if, the Fed cuts rates, unless the Fed is cutting into a crisis like 2008. So of course they were cutting in '08, but that it didn't initially give any kind of boost to the gold price. But if the Fed is cutting, ahead of time, if they're being more proactive, then I think that'll be a big shot in the arm for the gold price. I think that'll be the signal everybody's waiting for, and probably silver as well in that kind of environment.
Well, let's hone in on the Fed potentially cutting rates. You said it's a question of if not when. You noted in your recent gold outlook from Monetary Metals, gold and silver prices will rise when the Fed cuts rates again, with the caveat that if the Fed is cutting rates into an economic crisis like 2008, then they may fall first before moving upwards. We've heard a lot of kind of people who take the stance that we're going to see higher rates for longer. Um, we see such contradictory information. It's very difficult to look at the Fed themselves to predict what they're going to do, because people like Powell often will say two contradictory things in the exact same sentence regarding their future policy. Um, so why do you think the Fed will be forced to cut rates, and do you think it will happen in 2024?
Yeah, I chuckled because even the Maestro of Greenspan, or maybe I should say, especially the Maestro of Greenspan, um, talked about Fed speak, and when he became Fed chairman, had to master this art of cutting a big fork in your tongue and speaking out of both corners of your mouth at the same time, deliberately. This is a feature, not a bug. I mean, you think any normal person, my goal when I open my mouth and talk is I'd like to be as clear as I can. I want my audience to understand what I'm saying. I might not always succeed, but that's the goal I aspire to, at least. But their goal is to obfuscate and apparently give something to both sides. Um, it's political. It's not about understanding the world better. It's about serving contradictory, interests. Because obviously there are significant economic constituencies who want higher rates, and there are significant economic constituencies who want lower rates. And so, if you're a politician and you want to appeal to both of them, how do you promise yes but no, large but small, fast but slow, now but later? There's a whole art of speaking in tongues. I don't know what you call that. So the question is to why will they be forced to cut rates in an environment where interest rates have been falling for 40 odd years, which is the environment we were in until the Fed recently decided to embark upon what will prove to be its abortive attempt to reverse that. And there's been several others. And if you look at let's say the federal funds rate, you look at the 10-year Treasury bond rate, you look at any graph of interest rates in the West, the falling trend is absolutely striking and obvious since 1981. And there's been times, if you look at the Fed funds rate, that's the rate that they administer. That's what they dictate. The 10-year is a bit more of a market. You'll see where they tried to, it's mostly down. You see there's places where they try to go up. And those are where the gray shaded areas are, the recessions. Getting back to recessions or downstream of credit. So they trigger recessions in order to prove that they can, that it's a two-way market or whatever. I don't know what they're either kidding themselves or promising politicians or the financial markets or whatever it is they're trying to do. But in that environment, when rates are falling, then returns on capital are falling, have to fall, right? So if you run any kind of business, I mean, I like to talk about a chain of hamburger restaurants, but let's say you run a factory that manufactures, some sort of widget. So let's, instead of talking about hamburger restaurants, let's say you're the factory that manufactures fryers that every hamburger restaurant has to buy when they open up a new restaurant. And, you have a business case in a spreadsheet in your back pocket to expand. And, there's always at the margin, thoughts and ideas about expansion that aren't pursued because the bottom of that spreadsheet is red ink. It's not going to work. And, that's because expenses are greater than anticipated revenue, so you don't do it. Then they cut the rate of interest. Now, interest expense is one of the big expenses in a spreadsheet like that. So they cut one of your big expenses. And so with no other change in demographics, buying habits, anything in the economy, with no other change, suddenly your bottom of your spreadsheet, that last cell, flips from red to black. and now suddenly it makes sense. So you embark on borrowing money to build another production line. At the edge of your building, you have room for one more line, or maybe you buy another building or build one on your land and put in another line to manufacture, fryers at a greater clip than ever before. Everywhere in the economy, the same thing is happening. And so, unless people suddenly just have an appetite to consume everything more than they had, which is not the case, then all that's doing is just pulling down the return on capital. All the invested capital in the entire market is now reset to have a return, which is set as a margin, lower with every drop in the interest rate. And interest has been dropping for 40 odd years. So there's an arbitrage between return on invested capital and cost of capital, the interest rate. Every time this ticks down, process of arbitrage, we'll keep pulling them all the way down. And so when you get to zero, now I guess if you're a business of, let's say, single A credit, the cost wasn't zero, but it was 2.5% or something like that, then the return on capital will be pulled down to marginally above 2.5%. And what that marginal amount is depends on the industry. So some industries would pull it tighter, some industries need it wider for greater safety margin, but it'll be pulled down. Now you reverse it and you say, okay, well, let's put the interest rate, or the Fed funds rate to 5.5%, which means that single A credit is borrowing at, I don't know, 6.5 or 7 or whatever it is now. And that doesn't mean that all that return on capital has been pulled down to 2.5 or 3% or whatever, just suddenly teleports upwards. That return on capital is what it is, and now it's been rendered submarginal. And so what has to happen is mass liquidations, destruction of all those businesses and all that productive capacity. And that process, by the way, will involve enormous amounts of layoffs and huge, staggering losses to the banks, which makes the banks less willing to lend even to sound businesses. And so even more layoffs are coming, which means a decline in demand, a massive decline in demand. The decline in supply must be greater, such that eventually the few survivors finally have enough pricing power left, even though demand has collapsed. Supply is collapsing even more. So that what's left is that that remaining bit of supply has pricing power sufficient to set prices such that return on capital is finally above whatever the new market interest rate is. I just don't think there's the political will. I mean, leaving aside the question of whether, if I was the central planner, if the economic dictator offered me the job that John Galt and Atlas Shrugged refused, and even assuming I accepted it, and even assuming I thought there was a right answer as to what the Fed should do, both of which are false. Leaving aside the question of whether this would be the right thing to do, I don't think there's any political will for that kind of mass liquidation. I think the voters would become extremely restive. The entire economics profession, from the diehard central planners, from the people who work for the Fed on payroll, from the economics professors who basically live by Fed grants, all the way to the most strident critics, everybody, from Paul Krugman to Stephen Moore and everything in between, would be saying this is wrong. The Fed should, make credit conditions softer. We shouldn't have this liquidation. We shouldn't have austerity, so called. We should ease up on monetary conditions, and which is what would happen. So I think, the Fed. That's why I say when, not if. The Fed's going to reverse when they perceive that crisis, getting closer to unfolding, which today, so far it's not. So, there's a lot of lags in the economy. These things take time to play out, and right now the Fed is pretty sanguine about it.
Well, let's talk about what this all means for silver, because I don't think there's the same setup for silver as there is for gold. As you were mentioning earlier, the various countries that we're seeing more retail buying in recent times with gold, I'm assuming the trend isn't the same with silver. And obviously there's an industrial component to silver as well, massively used in a variety of industries. How do you see the current setup for silver? Do you still see it as money in this day and age? Has it become more of an industrial commodity? And what are the catalysts that you think could move it higher?
I do think it's still money. but it's a different kind of money. And one of the questions you have to ask, markets tend to be winner take all over, when they're given enough time to play out. And, over thousands of years, one thing emerges. It's why, for instance, that even in the United States, there's a certain standard width for roads and for vehicle chassis and railroad gauges, and it goes back to the Romans, and the war chariots were wide enough for two horses behinds, in between the two shafts to pull it, and that won out, right? And so all the roads had ruts in them. If you tried to build a wagon that had any width of its wheels other than that, you'd be breaking your axle, every minute on the road. But if you had that exact width, you could go down the road without a problem. Um, so the question needs to be asked: why to monetary metals? And they're both similar, although that's not really the reason. I mean, they're both heavy, they're both shiny. One doesn't tarnish, the other is pretty hard to tarnish. It doesn't. It's not like it corrodes away like steel. You get a little bit of tarnish on the silver, and that's pretty much it. Um, and they're shiny and they're malleable and all these things. Why two monetary metals? And the answer is the reason why you have a money of any kind is marketability. That's the loss, the measure of the loss you take to trade in and out of that good. If you're using it for indirect trade, if you're selling your goods and being paid in the monetary good, and then immediately turn around and trading the monetary good for something else you want the least losses. So you want the narrowest bid-ask spread, and that's gold. But it turns out that's gold for large transactions. For small transactions, if you are a wage earner, and you want to set aside 10% of your wage, you might be buying 2 or 3, 4 ounces of silver with your wage, or a small fraction of an ounce of gold. And it turns out that a small fraction is emotionally unsatisfying. You end up with this tiny little flake of gold. It's not very satisfying. You could lose it in the lint in your pocket. Um, and gold, to make something that small with precision is more expensive. And so the bid-ask spread on gold in that size quantity is wider than the bid-ask spread in silver. And so silver was the working man's savings. And a lot of working people never had their hands on gold their entire lives. Historically, an ounce of gold was always just an awful lot of money. So gold. So people say, "Oh, gold for bigger transactions, silver is for change." Not exactly, because the transactions, including the wage itself and the savings in the wages, fit silver really well, but not gold. And that's still true today. So when people talk about stacking silver, that's very often skilled tradespeople. Gold trades as a capital asset against other capital assets, so that's the capital owning class. So you do have silver demand. In fact, recently I was reading there's record silver imports into India. So that's why silver is $25 and not $21 or whatever, as it was not too long ago. China has long had an affinity and a history of a silver monetary system. Um, they do buy silver in Turkey, as well. Um, but silver, I guess, is always perceived as the junior metal, and in something like this, especially a stealth bull market that people don't really necessarily trust, it's easier to buy gold than risk getting, big wipeout in silver. So I do think, yeah, there's a time when silver will play catch up a bit. But the thing that's tempering it is that the plight of workers that are dependent on wages hasn't been for a long damn time, and isn't, right now particularly robust. Yeah, wages are up, but then of course the cost of living is up even more. And so, how much disposable income do people have for savings at the end of the day, isn't necessarily up. Um, and I'm not sure that's going to change. But the capital class can certainly discover silver and say, "Wow, silver's really cheap." Look at the ratio of gold to silver could hit 100 or whatever it does, and then they may snap up silver as a value play, as another way of playing the gold bull market, or whatever. And as long as this continues, yeah, I think that's in the cards at some point.
So, governments, central banks create perverse economic incentives. I'm just wondering, the state of the world at present when it comes to the global economy and how it's influenced by these forces that are not natural. You were also seeing a move towards socialism more and more in the West, in the US, in my home country of Canada. It's happening in Ireland, the UK, etc. We're seeing the erosion of society through radical ideology, whether that's gender ideology or otherwise. There's a lot of crazy thoughts out there that are getting printed in the mainstream press as somehow normal. Now, there's a camp here that's saying, well, this means the Western world is in an irreversible decline. The future strength lies in emerging economies, in places like the BRICS nations, in the places you pointed out, China, India, Turkey. However, as you also mentioned, they're having problems of their own as well. So I'm wondering how you see the whole global picture playing out. Is the whole global economy headed for inevitable disaster? Are there some parts of the world that are more insulated from this and protected than others?
So a couple of good questions there. I guess the first I have to say I'm not a believer in fate or that things are predestined or inevitable. I'm a big fan of J.R.R. Tolkien and Lord of the Rings and the whole Middle Earth thing. And one of the themes of Tolkien that occurs over and over is that there are situations where people think they're certain of what's going to happen, and it just they should not to be mistaken. They've looked into one of the Palantir, and they saw a glimpse of something, and they thought, oh, that means this, and they're just wrong. It's just as a matter of fact. And Tolkien is in his particular religious views and other things, thinks that despair is a sin. Um, and you don't know the future. Nobody does. So I don't think anything is, predestined or anything like that. Um, I think there's a lot of very worrying trends in the West, but I think there are two. I mean, you mentioned specifically the gender as a social construct, which in a certain sense, I guess that's the logical end of, the left for what, 6 or 8 or 10 decades has been saying everything's a social construct. So they finally got around to lumping gender in there as well. But I think there's a sign for hope there, which is that's one of those wedge issues that the left drives a wedge into itself. There are a lot of feminists whose daughters, participate in sports. And when you get an XY person who suddenly decides to put on a dress and compete against the XX regular girls, it's almost hard to even talk about it so that you're clear that everyone understands what you're talking about, and to try to avoid tripping on any of the trigger words, or at least they trigger the left anyway. But this not only are the former boys that are putting on dresses, taking the prize money and the scholarships, which is frustrating, these legitimate women to no end. But in a lot of these sports, there's the possibility of violent contact, and even sports that aren't really. I mean, okay, hockey is one thing, or American football, or something like that, or rugby, but soccer isn't primarily a contact sport, although it happens. But you have two people running from the ball in different directions, and one party has 30% or 50% more mass than the other, and a lot more strength, a lot more speed, and also just a lot more aggression, just more ferocious. Um, the girl's going to get clobbered, and it's going to be sent to the hospital in a lot of cases. And I think this is one of those issues where the feminist contingency on the left and the genderist contingency on the left are going to be at odds and not at all in agreement on this issue. Not to mention, 80 or 90% of the independents and probably 100% of the conservatives, would be siding with the legitimate girls against these interlopers in their sports. The other one, the global warming thing that just, they set a doomsday date. And if you read the doomsday predictions from the late 1980s, that doomsday was either 2000 or 2005 or something like that. Well, every one of those dates comes and goes. And, it's not really getting any warmer. And then they just reset it. Doomsday was postponed again. And, I think they lose credibility. So when the left sticks to, let's say, social justice, to take one of their things, they're talking about morality, it's much harder for people to see that what they're saying just violates fact and logic and reality and reason. But when they talk about something that is scientific and subject to not only scientific observation, but everybody can readily observe. It's not like Canada suddenly became the way Florida used to be and Florida is now the way Venus used to be or anything. Life goes on and people continue to flock from northern cold climates to more, tropical or warmer, Sunbelt, regions in the United States. How long can that go on before people are like, hey, wait a minute? Now, and if you get mass trends of people questioning both, global warmingism and, gender constructism or whatever you call that, then a lot of other of these things that are disintegrating our society are called into question. So that's very positive. On the other hand, the trend towards socialism, the trend towards I'm a victim, therefore the government has to give me more free shit, continues unabated at the moment, and continues to weaken the West, and of course the monetary system. So a lot of people don't know this. A lot of people know that there was a treaty at Bretton Woods in 1944, and if you think about it, yeah, that's because the Allies knew they were winning the war at that point. So it was time to start talking. Yes, they had some more mopping up to do, but it was time to sit down and talk about the post-war order of things. And nobody wanted to think about gold anymore. That was done. That was a barbarous relic. This was the time of Keynes. So, they sat down at Bretton Woods, and the reality is, okay, we called them allies, but America was the lone superpower standing, and everybody else was prostrate and, really wrecked by the war. I mean, the war was horrific in Europe and in the UK. And so the US dictated to the rest of the world, this is how it's going to work, to its allies first, and then everyone else signed on, later. Obviously, the defeated Axis powers and a lot of other countries that really didn't participate in the war, only peripherally. Everybody signed on to this order later, and the U.S. dictated it. So that's pretty well understood. What's not too well known is that the architect of this insane policy or monetary system was Harry Dexter White, who was a political apparatchik in the Roosevelt administration. And Harry Dexter White was later proven in criminal court to be a tool working for the Soviet Union. His goal was not to make America stronger and the rest of the world weaker. His goal was to undermine America and ultimately see its collapse. And he devised a very clever way of doing that. It's just that it took a lot longer than he thought. He didn't live to see it. Nobody in that generation, could imagine what would eventually come. That system is undermining America and has been for many, many decades. And unless the world transitions to another system, then absolutely it's going to be a collapse of America, collapse of the monetary system. That will be a huge catastrophe, even for the countries that don't like America. I say to people, if you don't like Pax Americana, you're really not going to like what comes next, which is chaos, which is every little warlord carving out his own little fiefdom. There's not going to be such a thing as international travel, not going to be such a thing as international logistics and shipping, because the pirates will shoot anything down or sink anything that moves without paying tribute to them. Be a return to the barbarism that prevailed through most of world history and prevails internally in many places of the world today. And I don't see, other nations rising to any kind of height that America once had. They may rise in a relative way if America sinks faster than they do. But the thing that made America great in the first place is all the stuff that Adam Smith talked about 250 years ago. The rule of law, easy taxes, leave business alone. And that's not really what the trend in China isn't in that direction. That's not certainly Brazil, India, Russia. No way.
Wow. So you went from a bit of an optimistic outlook to perhaps what the worst possible outcome could be. What are the chances you think of that, the bleakest of bleak scenarios you discussed? What let me ask this instead. What would it take to avoid that scenario?
I mean, there has to be a broader change in the ideas and the thinking. As long as people think in terms of I'm a victim, therefore I'm entitled, and the biggest competition is to prove my group is more victim than your group. No, my group is more victim, and everyone is competing that they're a greater victim. I mean, that's hopeless. That only ends in ultimately Cuba or North Korea. That's really bleak. So there has to be a change in that kind of thinking. There has to be a lot of people that stand up and say, enough with this victim shit. Life is hard. There are a lot of things that aren't quote unquote fair. I always like to talk about there's legal discrimination and illegal discrimination. So we've defined certain categories where it's illegal, certainly for an employer, a bank, whatever, to discriminate on the basis of age, or I guess first race, then gender, then age, then sexual preference, or whatever, right? So those things, at least in the West, are very well delineated. In Asia, as far as I can tell, it is not illegal to discriminate as an employer based on race. I don't think it's illegal here at all. But there's a ton of other things that anybody who's an entrepreneur would face. You walk into a bunch of investors to pitch your thing. They look at you, they size you up and down, like, nah, not investing. I don't like you. You got a big nose. I don't like your hairstyle. I don't like this. I don't like that. Whatever. You didn't shave today. Forget it. Fuck you. Get out of my office. Sorry, I didn't just say that on there. I apologize. So there's all sorts of things that it is legal to discriminate about, and it's not that this is advocacy of that people should be irrational and make decisions based on non-essential things that don't matter, but rather it's time to get the law out of all this stuff and for people to take responsibility for their own lives and say, okay, I wanted a job from that guy, but he didn't give it to me. And maybe it's because I wasn't qualified. Maybe it's because he didn't like my skin color. Maybe it's because I'm not ready yet, but I'll be ready in a year with more preparation and practice or whatever. But I'm going to take responsibility for it. I'm going to own it. I'm going to get a job that I can get hired, or I'm going to form a company and I'm going to hire the people I want to hire. It's time for people to take responsibility. And if that happens, then that can be a big change. I write, and my swim lane is mostly the monetary system. The monetary system is killing us. It really, really is. This falling interest rate thing seems like a lot of fun. It juices up one hell of a boom. People confuse a boom with a good economy. I mean, go talk to any conservative, probably even half the liberals, and try to convince them that the Reagan years were actually a false boom. It's impossible. You can't do it. They love Reagan. Reagan was great. Reagan was brilliant. Volcker and Reagan, together killed inflation, gave us prosperity. Yeah, there's a lot of good stuff that happened, and there's some deregulation, other things, but it was a gigantic false boom. We need to get off this monetary system, and we have to get from this irredeemable fiat paper currency to a system that can have a stable interest rate, stable value to the money. That's obviously gold. And, if we can do that, then, we can reverse, 100 plus years of decline and, restore and continue to grow and build, what was and I guess still is lingering in a way the greatest civilization that the earth has ever seen.
Very well said, Keith. And I think that's a great note to end things on. It's been an awesome conversation as always. I always learn a lot chatting with you. Before I do let you go, could you tell us about Monetary Metals, where people can find it, and what it is you do there?
Well, in a certain sense, we're making it profitable for people to participate in that return to the use of gold as a more serious monetary asset and trying to change the monetary system. We do that by paying interest on gold. So normally, if you buy gold and you have to store it somewhere, you pay storage fees. And after a while, that gets beat. And it's better to get it. So we have a deal closing today. So anybody listening to this now, can participate, but there'll be another one paying 3.5%. So if you give us 100 ounces of gold to put in this deal, then at the end of the year, you have 103.5 ounces. So our website is monetary-metals with an S.com. My personal blog is keithweinereconomics.com. I talk about some non-monetary things as well. And my Twitter handle, I'm pretty active on Twitter, is at real Keith Weiner. That's KEI and WEI. And unfortunately, there are bad guys out there that like to, rip off, whatever, and have the misspellings of your name, KIEWIE, and things like that. But at real Keith Weiner.
Great. Well, I'll put links to all of that in the description below. Thank you once again, Keith, for coming on and sharing your knowledge with the audience.
Been a lot of fun. Thanks.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. Visit their website at arcsgo.com and reach out to the owner, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.